India gave out over 4 lakh crore rupees in small loans to poor women. These loans were supposed to lift families out of poverty. Banks celebrated, NGOs celebrated, and the government celebrated. But as of early 2025, 61,000 crore rupees of that money has gone bad. Microfinance institutions NPAs doubled from 8.8% in 2024 to 16% by March 2024. The small finance bank segment is hit hardest, with bad loans reaching as high as 22%. That's not a rounding error, that's a crisis. And here is what nobody is explaining. It didn't happen because borrowers are irresponsible. It happened because the system was designed this way. The incentives were always pointing toward this exact moment. I'm going to show you exactly how. Stick around, because what you learn in the next 10 minutes will change how you invest and read about any microfinance company story ever again. Let me start with the version of microfinance you've already heard 100 times. A group of women in a village. No bank account, no collateral, no credit history. Normally, no bank would touch them. But microfinance says, we will lend to the group. Everyone in the group guarantees everyone else's loan. If one person defaults, the whole group is responsible. It's called joint liability. The idea is brilliant on paper. Social pressure replaces collateral. Women repay because their neighbors are watching. The field agent visits weekly, collects small installments, and everyone builds a credit record. Over time, they've increased to bigger loans. The family moves a little bit on the social ladder. This model won a Nobel Prize. Muhammad Yunus of Grameen Bank of Bangladesh in 1970s. The story spread globally. India adopted it and scaled it. Today, there are 7.4 crore unique borrowers in India in microfinance. 98% of them are women. Beautiful story, right? Now let me show you what is the reality behind it. So here is the first thing the mainstream narrative skips. The MFI, the microfinance institutions doing the actual work in the village, is often not the one making the real money. Think about what an MFI does. It hires hundreds of people, hundreds of agents. They ride bikes to remote villages, sit in group meetings every week, collect cash and enter data. Massive operational cost, huge ground level efforts. But where does this MFI gets the money to lend? From banks. Large private banks, public sector banks and small finance bank. They lend wholesale to MFIs at relatively lower rates. Then the MFI lends to borrowers at high rates and try to pocket the difference. So the bank sits at the top of the chain. It earns a clean interest spread. It doesn't deal with weekly collections in villages. It doesn't manage credit risk at the ground level. It just supplies capital, and if things go wrong, it can reduce the supply immediately. Today, the banks and small finance banks directly hold nearly 50% of the gross microfinance loan portfolio. They have quietly captured the profitable end of the value chain. The MFI, meanwhile, bears all the operational risk, all the credit risk, all the people risk, and operates on very thin margins. This is not a loan for women. At the structural level, this is a credit supply chain. The woman at the bottom is the last mile. The bank at the top is the wholesaler. And the MFI is the franchisee in the middle, doing all the dirty work and absorbing the losses. Now here is the part that broke the system. For decades, microfinance had a rule. A borrower could only get money from number of lenders. It was designed to prevent over-indebtedness. It was safety belt. But in 2022, the RBI removed the cap on how many could lend to one borrower. The intent was good. More competition, more access, lower interest rates. But what actually happened was race to the bottom. Every MFI wanted to grow its book. Every bank wanted to deploy more capital. And borrowers were already stretched, started taking loans from 4, 5, 6 lenders simultaneously. Each lender thought they were the primary creditor. None of them knew about the others. Today, over 55 lakh borrowers have active loans from 4 or more lenders at the same time. I want you to picture that. A woman in rural Bihar. Her household income is maybe 12,000-15,000 a month. She has EMIs going to any NBFC, a small finance bank, two other microfinance institutions, and maybe a local money lender as well. Everyone thinks their loan is being repaid from her income, but there is only one income. That isn't financial inclusion anymore. This is a debt trap, giving message of empowerment. When one loan goes bad, the domino effect is immediate. It defaults on the next one. The joint liability group fractures. Other women in her group who are repaying perfectly now face pressure. The whole structure built on social trust collapses. Let me give you the data so you can see how far this has gone. Gross NPAs in the microfinance sector hit 16% in March 2025. That's nearly double to what it was just a year before, 8% in 2024. In absolute terms, 61,000 crore rupees in bad loans. To put it simply, while microfinance institutions do check PAN cards and credit bureau reports like CBIL or Equifax, several loopholes and systematic pressure allows a single borrower to take multiple loans. First is the reporting lag. When someone takes a loan today, it doesn't show up on the credit report instantly. It takes probably 2 to 4 weeks for the bank to update the bureau. Borrowers often exploit this window to apply at 3 or 4 different institutions simultaneously. So before the first loan appeared on the record. Second is the data blind spots. Credit bureaus only tracks formal loans. They cannot see debt from local money lenders, informal chit funds, or even small self-help groups. A borrower might look clean on CBIL, but he would be drowning in informal debt. Third is the target-driven lending. Field officers often have strict monthly targets to disburse loans. To meet these quotas, they might overlook borrower high debt-to-income ratio or ignore red flags as long as the basic KYC is valid. Fourth is the split borrowing. MFIs often lend to individuals, but the household acts as one economic unit. A husband might take 2 loans, wife takes another 2, and the son takes another 2. On paper, there are 3 different borrowers with a clean histories of paying bills, but the total family income cannot support 5 EMI payments. Fifth rule is bypassing. Although the RBI has guidelines on how many MFIs can lend to one person, typically capped at specific number of lenders or total indebtedness, aggressive NBFCs and MFIs sometimes ignore these caps to capture the market share, especially in booming rural markets. This leads to over-leveraging, where the borrower total monthly EMIs eventually exceed their total monthly earnings, leading to a default cycle. And here is the response of the industry. Lenders panicked and stopped lending. Disbursals in the last quarter of financial year 25 dropped 34% compared to the same quarter previous year. In response to these systematic issues, the RBI introduced new regulatory framework for microfinance in 2022. The goal shifted from limiting the number of lenders to focusing on the borrower total debt capacity. Here are the key changes implemented to stop overlending. First is the fixed income to debt ratio. No MFIs can lend if the borrower total monthly loan payments, that is EMIs, exceed 50% of their monthly household income. This forces MFIs to look at the wallet share rather than just the number of loans. Second was the common definition of households. A household is now strictly defined as a husband, wife, and their 2 unmarried children. MFIs must now assess the combined debt of the entire family, not just the individuals. Third regulation was removal of interest rate caps. The RBI removed the rigid interest rate ceiling, allowing MFIs to price loans based on the risk. In exchange, MFIs must be transparent and cannot charge high interest rates or hidden fees. Fourth was the no repayment penalties. To help borrowers get out of the debt faster, MFIs are no longer allowed to charge penalties if a borrower wants to pay off their loan early. And the next is a strict credit bureau reporting. MFIs are now required to update the credit bureaus more frequently to close the reporting lag that borrowers were exploiting to take the simultaneous loans. And despite these rules, the 2024 and 25 crisis shows that ground level implementation remains a challenge, as some lenders still prioritize growth over the safety margins. Think about what that means for the good borrowers. The woman who was repaying on time, who needed her next working capital loan to keep her small business running, she also can't get a loan now because the lender is scared. She becomes collateral damage in a crisis she didn't actually create. So the system rewards aggressive growth on the way up and punishes everyone indiscriminately on the way down. Let me make this concrete. Think about your colony's Kirana uncle. He's been running his shop for 15 years. Good reputation, small but steady income. One day he takes a loan from SBI. Fine. Then a chit fund approaches him. He takes second loan. A fintech app gives him instant credit. He takes the third loan. His brother-in-law lends him some money. That's a fourth loan. Each lender thinks they are the primary creditors. Nobody checks what the others are doing. One slow month, maybe a festival season, when his supplier raised prices, he can't service all 4 debts. The domino falls. Now the SBI branch manager calls this a credit risk. The chit fund calls it a fraud. The fintech app freezes his account. And the brother-in-law stops talking to the family. But the uncle's actual problem was that 4 different people lent him money without asking how much does he already owe. That is the microfinance crisis, scaled to 7 crore individuals across India. Now, I'm not telling you to invest or not to invest in any microfinance company. That's your decision and your research to do. But let me give you a list of 5 essential questions as a curious investor should be asking before putting his money in microfinance stock. First, what percentage of this company portfolio is in high penetration states like Bihar, West Bengal or Tamil Nadu? These states have historically seen political interventions in loan repayments. That risk is real and it's recurring. And second question is, what is the average number of active lenders per borrower in their book? If the management doesn't disclose this, ask why. If it is above 3, what is their answer? Third question is, how is the company funded? Bank credit lines or market borrowings? When credit markets tighten, which funding source will disappear first? And how many months can they survive without fresh disbursements? Fourth question is, look at PAR 30, portfolio at risk beyond 30 days. So this number moves before official NPA number does. If PAR 30 is rising fast while NPA looks stable, the NPA number is lying to you. It just has not been reported yet. And the fifth question is, go back and read what management said about asset quality 4 quarters before the last NPA cycle peaked. Now read what they are saying today. Does this match or the language rhymes? Microfinance is not an inherently bad sector. The idea of extending credit to people who are locked out of the formal system is genuinely important. But a good idea, when it gets captured by growth incentives and loose regulations, it stops serving its original purpose. The woman in the village stops being the mission. She becomes the metric. So that's what happened here. And understanding that, really understanding the structure behind the story, is the difference between reading a headline and reading a situation. And that's what I do on this channel. If this made you think differently about something you assumed you understand, hit subscribe. I will see you in the next video.